chair at all?
No, I'll stand.
Okay, let's get started. Today we have a speaker, Peter Layton. He is one of the pioneers who had developed algorithm trading systems way before this course even thought about being developed. I would like to, Peter would say more about himself later, but just a brief introduction. I think Peter got his degree from University of Chicago, and he worked at Goldman Sachs as a partner for a long time. And recently, I've been working with Peter and developing some trading algorithms. And we are very fortunate to have speakers like Peter come to our class. So let's give him a warm welcome.
Thank you. Well, thanks very much. So part of my talk is going to try to impress how quickly things change in the world of when you're trying to design algorithms and how you must adapt to them. So I'm going to start you with a quiz question that someone asked me the other day, and I didn't know the answer. I got 3 of the 4. See how you guys do. And I think I sent this to Dr. Velu, so hopefully he didn't already share it with you. So there's the largest taxi company in the world that doesn't own a car. Do you guys want to tell me what that is? Excellent. The largest retail firm. Very good. Doesn't have any inventory. Largest hotel that doesn't own any real estate. Very good. Largest media firm that doesn't produce any media. Very good. So things change in a hurry, and one has to be aware. And that's a good cocktail trivia question for you guys to use later. But anyway, so my general themes I want to stress are that the market structure matters. So when you're fitting algorithms, it matters how the markets are set up. Government regulation matters a lot. You have to be aware of that. There are a lot of roadblocks to innovation. You think something's legal? It may not be. And you got to really dig into that or you can get yourself in a lot of trouble. Technology and opportunity are constantly evolving, and it's really easy to screw up when you design an algorithm and put it out in the marketplace. I'm going to go through a lot of material. Hopefully we can get through it all. It's not, and I put in my title, I'm a practitioner. I'm not teaching a statistics course. That's for Dr. Velu. But I will talk to you about all the pitfalls that we found when we're modeling what we consider. So I'm going to go through a lot. It's not difficult to understand, but it's complex, if that makes sense. So my resume, I'll go briefly through this. I graduated at University of Chicago, and I worked for Merrill Lynch, and we were actually on the trading floor. My job was, when someone was doing an option trade, they needed to lay off their risk. They would say, go buy 10,000 IBM or sell 10,000 Exxon. And I would call my New York brokers and they would do the trade. So I did that for a while, but it was at the advent of, that's how old I am, it was the advent of program trading. So pretty soon I was doing hundreds of thousands of stuff on the close. Merrill Lynch would call and say, who are you doing these blocks? And our institutional clients want to get in. I said, no, that's not what it is. This is a program. This is an arbitrage opportunity. There is no in. There's no negotiation here. So Merrill sold me rather than explain to their institutional clients what the heck we were doing. But we had things to deal with like index arbitrage and triple witching. So I then took a job at the SIBO after I got sold because they paid for graduate school back then. I don't know if anyone pays for graduate school now, but they did back then. So then I went back to the University of Chicago, and I was director of research at the CBOE, where things like portfolio insurance and long-dated options happen. And our first little hiccup in the market that I got to experience firsthand in 1987, where my wife called me and said, I don't know if we own our house anymore. And I said, oh, thanks, honey. She was trading for herself in another area. So after I finished my graduate school, Blair Hall called me and said, hey, I want to hire you. I want you to go and start our office in London. So I went to the London Stock Exchange where I traded options on the LTOM. And it was open outcry back then. And they enjoyed trading in Cockney rhyming slang and also making fun of my accent when things got slow. I don't think I had an accent, they did. 1989, another little market hiccup, much worse over there than it was here. It happened really overnight. Then we started working at Hull on something called volatility arbitrage. And I was sitting in a statistics course, what level is this, 200? So it's very similar to this. And actually it was a finance course. And we were learning about CAPM, and so how to optimize a portfolio, how to deal with the covariance. And I said, hey, we can apply the same model to volatility. So we designed, I remember writing up the equations that day, going to the SIBO floor the next day, doing the calculations and saying, okay, so if we can buy a basket of volatility versus selling the volatility on the index, that's an arbitrage. The other way, it's relational, right? But on one side, it's a pure arbitrage. So if you can buy for parity a basket of individual volatilities and sell the index volatility, you've got quite a trade. So boy, sure enough, we were trading pretty near parity. So I went down, had my traders go out in all these different trading pits, and there were O'Connor and another firm had figured this out already. They were already putting on the trade. So 3 of us are now doing this trade. But that's how things evolve so quickly that we'd laugh. We'd see each other running to the same pits at the same time because the opportunity was there. Well, we were doing volatility arbitrage and we're trading baskets of equity options versus the index options. We said, we really should start working on trying to predict all the variables that go into an option pricing model, and that included the underlying. So at that point, believe it or not, from my Merrill days when we were charging 5 cents a share, commissions for stock trading got down to a sub-penny. And sure enough, when we modeled our equity forecast, we could make about 3 cents. So we could pocket 2 cents. And so we started trading that. We started doing millions and millions of shares. I got calls from the SEC, very much like when Merrill called me earlier. Who are you? Why are you trading so many millions of shares? And you're just a little firm out of Chicago. So I invited the SEC in. We showed them everything we were doing. And for that reason, they still call me when they have things that they can't figure out. One of the things that really jump-started our ability to do the high-frequency trading, not only did the technology come around, the exchanges started going electronic, but we started using genetic algorithms. In other words, you're trying to optimize multidimensional space. You're at the highest point of a mountain. You don't know if you're at the highest point of the mountain range, right, as you're doing these optimizations. So genetic algorithms would make us try to do a much better job mapping the solution surface. And that was a real breakthrough because it really changed all our parameters and really allowed us to trade a lot more. So my resume, Goldman saw this going on, so they bought me. I bought Hull Trading, and in which I spent my years with them expanding high-frequency trading and statistical arbitrage. I put down there's a culture war. It's very interesting to go with a very statistically minded approach into kind of an old staid bank. So if you're going to do that, be aware. Now they've all converted. You can't find an old-time trader in any Wall Street firm. They're all guys like you or computer programmers. And when I say guys, men and women like you and computer programmers. So it's kind of culture war. The one nice thing was cash doesn't matter, right? Risk capital matters, but cash doesn't matter to a firm like Goldman. I had my CFO call me one time and said, okay, we're 5 billion long, 5 billion short. And I said, yeah, but our risk is near nothing. He said, well, that's a nice benefit for working for a firm like Goldman Sachs. We started dumbing down our algorithms, and I shouldn't say that. We took out the forecasting components of some of our algorithms and revamped them and gave them to clients to do their executions. Because part of the process of designing an algorithm is, at least the way I always look about it, is you have a forecast side of it, and then you have okay, so I think I have an edge. How do I interact with the market most effectively? And that side of how do I interact with the market, we packaged and sold to, or gave to clients to do their execution. So if some large institutional customer wanted to do 200,000 Exxon, we gave them a VWAP algorithm or any benchmark they wanted to meet. We just had the computer slice and dice and trade it. Our hiccup back then was long-term capital. Our lesson there was just because it's not correlated before doesn't mean it doesn't become extremely correlated. So when the long-term capital debacle happened, we had things that were never correlated before walk in lockstep. And it was really a liquidity component. It came into the market so strongly, and we had risk to it, but we didn't even realize we had risk to it. It's just a lesson learned. After I left Goldman, we started, I've been an investor and an owner of Efficient Capital, which is a managed futures operation alternative asset. And then we're doing a very similar thing in ECM called Blackthorn Capital, where Dr. Velu is helping us. My old boss and I had a standing bet. We both started investing in Efficient Capital. So they have multiple managers that trade to capture alpha, and he sold his interest in the firm because he said there's no way you can take fees twice and it can't be efficient. Well, it's been efficient for 15 years, or efficient enough. So he got out, I'm still in, and we'll see who wins. The other notion is the role of big banks. Big banks have gotten much more involved in the market because of their ability to internalize order flow. The other element of the efficient capital in having multiple managers is, so by wisely choosing multiple managers, efficient capital has the same return, expected return, but he cuts his risk by 60%. That's the edge. So portfolio construction in your algorithm is key to controlling your risk. Our hiccup there was 2008 and MF Global, which kind of rocked those markets quite a bit. So now what do? I do those things, and I also have a company called Tallgrass Group. We do mitigation banking. So I was trying to see something green that looked a little financial too, and I invented this company. So we're doing mitigation banking and restoration in the Midwest, trying to do a portfolio approach by having lots of mitigation banks diversifying across municipalities, governmental agencies, states, economies. It's not easy to do, but we're trying. Box Options Exchange, I told you I became friends with the SEC, so a fledgling little exchange called me and said, hey, we hear you're friends with some of the folks at the SEC. We've got an exchange that's done some bad things, or the previous owner of the exchange did some bad things. Would you come and promise you'll clean them up? And so that's what I did. So I'm still chairman of a small exchange on the option side. So what do I want to talk about today, if we can get through it? Review of the exchange structure in the US, evolution of US markets, review of trading strategies, basic guide on how I build a model, and then a discussion about equities and derivatives, some of the strategy differences I think about. So in the US, we have a dual regulatory environment. Again, when you're designing algorithms and you're looking at the different asset prices, this is key to know. The CFTC versus the SEC. They lead to monopoly power over some products and pure competition over others. The CFTC and the FTC have regulatory differences we'll get into. Some of the products are fungible, some are not. And we're going to compare some of the landscapes to tell you how crazy it is out there. So the CFTC does futures and futures options. SEC does equities, ETFs, equities and index options. They grew out of a historic occurrence. CFTC was established in '74 to replace the Commodities Exchange Act of '36. The SEC was established in '34 to regulate stocks. So once upon a time, they really didn't have anything to do with each other. It's just that the evolution of products have made them overlap. So now you have, on the CFTC side, we have options on the S&P 500. We have the S&P 500 future. On the SEC side, we have the S&P 500 option, and they have, like the CBOE has its own futures exchange now. So there's this incredible crossover now in their regulatory authority, and yet they don't play very well. And so you have to be aware of who you're working with. Will there be a merger? Hank Paulson tried to broach the subject, and then 2008 happened, so that didn't happen. So it's unlikely that there will be a merger between those organizations. So what's the difference? SEC tends to be rigid and rule-based. The CFT tends to be more flexible and principles-based. In other words, they don't write down every rule. They say, this is how we want you to act, and then they'll judge you on whether you're acting towards that theme or not. The cons of this dual regulatory structure is, as I told you, there's a lot of overlap between the S&P 500 ETF and the options versus the futures and the futures options. There's actually something called single stock futures. You can trade an IBM or an Exxon future. Barely trades, but again, it's why are they being regulated in different places? It impedes the market development. CME has refrained from buying an equity or options exchange because they don't want to be regulated by the SEC. And certain class of investors can only trade SEC products and not necessarily futures products. So there's a lot of confusion out there. There's also over-the-counter trading. When something trades on the exchange, the counterparty is the clearing firm. It says exchange here, but it's really the clearing firm, centralized clearing, such as the OCC and options. Things are marked to market. There's margin requirements, there's transparency, and it's highly regulated. In the OTC, these are bilateral agreements. Things are not transparent, and this is in 2008. This is all the stuff that blew up. So there's been a big push to get those swaps onto a clearing mechanism where they become more transparent. So if you're modeling, and here again, if you're looking at financial products, you have to have this notion of, could there be a liquidity risk embedded in some of these OTC products? Is there counterparty risk that I have to price? So you can't just look at them in a homogeneous manner. You really have to get in there and understand this stuff. Fungibility, what that means is if you buy a share of Google on one exchange, you can sell a share of Google on another exchange and you have no position. If you buy a futures product, it clears with the clearing firm associated with that futures exchange. So if they have the same contract in another exchange, you would have a long and a short position and you would not be closed. So those second products are not fungible. Spot markets are extremely fungible. That's just the cash. Equity options are fully fungible. And index products are fully fungible. And then futures and options are not fungible unless you trade them on the same exchange. Here's an example of non-fungibility. So the same corn contract trades at the CME and trades at the ICE. And so you could look at the prices and trade it, and you'd be much less likely to want to have two open positions. So you're almost forced to go back to where you first traded it. What is the results? Most futures don't have multiple pools of liquidity because no one's incented to spread your trades out. Versus the SEC regulated products, there's a plethora of pockets of liquidity. And really what's happened is technology is doing all it can to link them. But if you trade an option or a stock, I'm going to guess you have no idea where you traded it, right? You just type it in, you get your fill. But you could look in and say, oh, where was this sent? Where was it traded? Did it even get to an exchange? It might have just been filled in a consolidator's book. So what happens with fungibility is you have this pure competition. Right, all these exchanges can compete because they can list the same products. In the non-fungible products, you have this monopoly, so they can charge higher fees, it causes, they have quite a lot of pricing control. So the pure competition, the U.S. equities options, has led to this Byzantine market structure where you have wild fee structures. You had alleged anti-competitive practices in the NASDAQ scandal for a few years ago. The monopoly in the U.S. futures and futures options markets, the markets tend to be more orderly. It's only one person in charge doing things and they can compete. They don't have to compete with anybody. It's kind of an irony, but it gets a little crazy out here. So there's over 10 U.S. stock exchanges right now. I list them here. The slide doesn't matter. It's just so overwhelming by, holy cow, there's over 10 exchanges right now where you can trade your stock just in the U.S. They all have different markets, and they do try to be linked electronically. People have a responsibility to go into the best market, but this is only half the story. We'll get to the other half of the story in a second. There's also over 10 equity options exchanges. My little exchange is right there, but it does about 5% of the market, so it's not big enough. Here's the futures markets, where you really only have, you have the CBOE Futures Exchange, but then you have the Merck and the ICE, and then you have some energy products on the NYMEX. But you don't have this plethora of exchanges. You just have a few. So let's talk about microstructure. For our purposes, microstructure is, okay, how's the market structured on the country level? So we're starting to talk about that. But then also, how do we want to look at it on a tick-by-tick level? So if you're going to build an algorithm, how do you need to study it? How do you need to understand the specifics of what does that price mean? And what are my costs involved with that price? So microstructure, the things that happened through my professional career is the unbelievable amount of automation that's occurred. And also the huge boom in exchanges. So there are also a lot of non-exchange traded entities around, such as dark pools. I think there's been a few books on that. There's also been a demutualization of exchanges. Exchanges have gone to a for-profit model versus a kind of a collusion or a club model. There are also different pricing models, which is very important to know. There's something being introduced as a make or take it price. So if you take liquidity from an exchange, you pay. If you make liquidity on an exchange, you get paid. So the fees, when you put an order in, you don't see it if you're trading through Schwab or Fidelity, but if you're running models, you care about where you send an order. How much is it going to cost you? And it's not always clear. So current trends, we'll talk about a little bit about our speed, proximity, regulation, and is the end of high frequency trading coming? So you guys all read Flash Boys in your off time? No? Okay. I was glad I was not mentioned in that book, so that was a good day. So the stock market, a little bit of history here. In '75, the SEC abolished fixed commissions. That's why my rates when I was at Merrill, we were charging 5.5 cents a share, and now people are paying me for my stock orders. New York launched DOT. DOT made the markets look electronic. They weren't, but it made it look electronic. So that's when we started trading in an automated fashion. But it still went to a human being who typed when you got to New York. 84, Super DOT replaced DOT, and the routing and the speed got better. They also started executing some small orders automatically, and that helped too. The one bias that you see, and I've hinted at it before, is a lot of the rules are written for small orders, right? The SEC writes rules to please the public and get out of the headlines. They don't write rules to say, hey, what's the best way we can get a 1 million share order through the market? So one thing that technology allows you to do, and these interfaces allow you to do, is to take that 1 million share order and make it look like it's John Q. Public's order coming from Iowa. You slice and dice it. So as you would guess, in our world of people trying to make money, there's a lot of people that just sit there and try to sniff and listen to see if they see a large order coming through the market trying to be disguised. So there's a lot of intelligence and effort put into that. So 1992, 75% of orders and 25% of volume was executed through Super DOT. So it happened in pretty much a hurry. So in 92, New York had a monopolistic power over listed equity trading, even though there was exchanges in Boston, Chicago, Philadelphia, and San Francisco. And I say why here, and if somebody wants to volunteer, that's great. If not, I'll tell you what I think. But there was only one source of price discovery, and that was New York, right? Because it wasn't transparent. He had all the information. He had the central limit order book. So the specialist knew which way stocks would tend to go just based on the liquidity he saw that none of us saw. Now that the market has become so fragmented, and people can, and more transparent, where you can see the book. You can get the book electronically now, and you can put it together. So you can make your own central limit order book. So there's a real transfer in information from the specialist to pretty much the electronic community. So options market started in '73. Options Clearing Corporation was formed. So unlike the Mercantile Exchange, where it has its own clearing entity, the options exchanges said, let's all clear our trades together. So a consortium was formed. Philadelphia and America started their own exchanges. And then the SEC in 1980 said, you know what, you can list options on Google. Back then it wasn't. I forget what was the first hot listing. Maybe it's in the slide. But you can list an option on an equity in multiple venues. In '99, Dell was the first one. So it took that long. So from nine years before the SIBO and the Amex said, okay, we're both going to list Dell. That's kind of odd, isn't it? Would you think that would have happened like a lot faster than that? So why did it take so long? Well, Scott Morris, who I work with, put this slide together. Evidently, he has an opinion about collusion, which I don't think I'll say. But it is odd that it took 9 years for 2 exchanges to list. So we also have OTC equities on the NASDAQ market. It's known as a dealer market back in the day, and dealers could only trade with dealers. There was electronic trading, but it was even worse than the New York Stock Exchange. It wasn't automated at all. You thought you were sending your order in an electronic venue. It wasn't. It came on somebody's desk, and they got to decide what they wanted to do with it. In 1988, market makers had to honor quoted prices up to 1,000 shares, making it a little bit more retail friendly, that you could get some sense of execution. Why this matters? Very hard to remember. We were doing program trading back in the 80s, sending 100 or 500 orders to the New York Stock Exchange and getting the closing price. We knew the fill. We could do the arbitrage. NASDAQ, you could send an order to the dealer market. You had no idea what price you were going to get. There was no way to do the arbitrage. So that was the biggest risk in program trading back then. But the NASDAQ component wasn't as big as it is now. So now it really matters that this exchange does not look like this. 1994, there was another famous paper called The Odd Ace. Christie published it, and I was actually on the panel down in Vanderbilt when they were talking about this, not because I was a NASDAQ dealer, but what he noticed was, how come no one quotes on the odd eighth? Everything's either at the round number, at the quarter, at the half, at the 3/4, and now we trade in pennies, but this is again how old I am. Why is no one on the odd eighth? And the SEC agreed with him that there was a collusive behavior, and they had actually tape recordings of dealers screaming at other dealers who would dare quote 3/8 of a dollar on something. So they got in a lot of trouble. So in '88, there was anti-competitive behavior at the NASDAQ markets, and the SEC adopted Reg ATS. ATS stands for Alternative Trading Systems. And what this did is it gave securities market the choice to register as an exchange or not to be an exchange, just be an electronic matching engine. And so now the market's looking electronic. So again, when you're trying to develop an algorithm, and you're using old data, especially if you're using older tick data or low frequency, less frequency data, you have to remember that the characteristics of the markets have drastically changed just here. Now this looks much more electronic, much more continuous, much more transparent than it did before this. So this changed stock trading in 4 fundamental ways. As I said earlier, it created the central limit order book, which the New York specialist had to himself. Now it was basically public. It proliferated trading venues, and then the demutualization and established trading venues, and then it introduced make-or-take-it pricing. So what role did technology and automation play? Well, it's pretty obvious. Computers and interfaces allowed this to happen. It wasn't really technologically feasible. There were a few firms, we were one of the early on firms that could do this stuff, but for the general brokerage firm they could not do this stuff. So why is a central limit order book important? Well, you get rid of the dealers, you get transparency, it levels the playing field. In other words, you can put an order in, and though you'll be slower than the other person, you can have the same fill expectations pretty much. Drastically cuts transaction costs, and it allows you to trade algos because you have some sense that if you send out a batch of orders, they will all hit the market roughly at the same time. So demutualization occurred, the CME went public, New York Stock Exchange went public in '06, SIBO goes public in 2010, and by now 2014, every major trading venue is a for-profit entity. And a lot of this is because the costs are getting driven down, but also because of the importance for capital for developing technology. This is a technology play now. These are technology companies. It also allowed these guys to cash out these people to cash out at very nice prices too. Multiple non-exchange and trading venues. Dr. Velu and I were talking about dark pools. This is a slide of dark pools. So this is not something that's transparent, but large institutional customers like going here. They like going to these dark pools where there's an agreement where I can put my order in. No one knows who I am unless there's a trade, but they can bounce their larger orders in there without showing the market, right? So even though things are transparent, I say that's a good thing. Well, it's a good thing because I'm a proprietary trader. I want to see everything. Well, if you're the guy with all the volume, you don't want to show me everything. So this has now evolved to an alternative venue, and it seems to be growing. It starts and stops because sometimes you see some bad press from the SEC about dark pools, lack of transparency. Again, I told you one of my biases, or I asserted the SEC tends to write its rules for the John Q. Public. This is not a John Q. Public rule. This doesn't play well in the press. That a lot of stuff is going on behind the scenes. Make it take or pricing. So I read a paper years ago that if you placed a limit order on the New York Stock Exchange, you're basically going short an option. You're giving away an execution option to that order because it's just sitting there. So you wanted to trade Exxon, and all of a sudden the S&P 500 future drops $1, and you had an order to buy. Someone's going to sell you that Exxon because it's overpriced based on where the market is. So that execution option was priced based on the volatility of the marketplace, varies by stock, but about 3 cents. That's a big deal. It's a huge incentive not to put out resting limit orders in the market where you're giving away the execution option. So to combat that, so volume starts disappearing from trading screens. Again, it's all transparent. Well, I don't want to be short an execution option to someone else to take advantage of me. So people start pulling volume off the trading screens. This happened to huge effect in Germany, where you look at their trading screen, there was nothing on there. And it almost goes back to a dealer market where people start pricing their stuff. So to combat that, they said, you know what, exchanges said, I'll give you money to send me a limit order. But if you take liquidity, I'm going to charge you more than the money I'm giving to the person to put the limit order up. So that's make it, take it pricing. So in other words, even with all the rules about trading venues, pricing, how you price orders matters. It actually affects the rules of how the exchange operates. And that's a key element to also keep in consideration. The high frequency trading firms, some trading firms just keep their risk negligible and just gather these fees. That's their strategy. Now, that's a strategy that's not as profitable as it used to be, but when these fees, you could just send orders and get fees, well, people started doing that. You know, because they could pick less risky stocks and less risky pairs to do that in and just get paid. So this is, again, nothing that you really need to look at the detail, but this is all the exchanges, not all of them, this goes down for another page or two. And these are all the different fees associated with whether you're sending a limit order or taking a market order. I'll show you an example in a little bit. Oh, there's also tape revenue that you'll get rebated. This is the complexity. So an average firm like mine has a routing table that knows all this and can send orders to the right venue at the right place, because what this says is the prices you see on the screen aren't the accurate price. Because if you could send it to one venue that will pay me for an order, another venue will charge me for an order, that's a different price. My example, BOX is the exchange I'm chairman of. This example is a couple years old. BATS is an alternative exchange. So if you add liquidity, we pay you 37 cents. If you take, charge you, or 0.3 cents, charge you 0.23 cents. BATS does the opposite. So that's almost a penny right there. So you'd be looking at a price, and it could be, in essence, a penny different than what you're seeing. So when you get data, you got to get the pricing table so that you incorporate that in your modeling. So current trends: speed, proximity, circuit breakers and governments, and diminished returns from ultra-high frequency trading are our current trends. I'm going to talk a little bit about speed. It's out of order with the market structure talk I'll go on to. But it matters because you've read so much about it. It's kind of interesting to see how people care so much about speed and how much money you can make with speed. Why it's ending is the speed of light is a hard limit. And we're getting pretty close to getting an order to an exchange and back by the speed of light. So they're shaving time. People care about these distances because speed of light doesn't matter. So proximity matters. So there was, in Flash Boys, I think the book talks an awful lot about this cable put between Chicago and New York. So remember, so here we have the futures, options on cash. Here we have the equities that make up all those derivative products. So the link between those have to be important. And so whoever could arbitrage, if there was a mispricing, whoever could get there faster would make a lot of money. So this is a lot of stuff that we did. The Cermak to Secaucus comment, why there? That's where the servers are, right? People don't put their main servers in the middle of downtown areas because bad things can apt to be happen to them, but they're pretty close to the actual exchanges. So it appears that the next book will be who puts the first microwave in, right? Because this is landline based, but you can shave some milliseconds off of if you do them via microwave. So there's talk in that regard. So New York to Chicago travel time, state-of-the-art microwave is 8.5, and the speed of light is 7.9. So we're getting pretty close to where this won't matter anymore. Co-location you'll hear a lot about. And that is the notion that you put your computer with your trading algorithm right next to the server at the exchange level, because the speed of light is that far. It doesn't matter. The cable's a foot long. And so this is done with regularity. I think this is an issue because John Q. Public can't do this, right? So there's inherent, but it's interesting because exchanges were set up that way in the first place, right? The New York Stock Exchange was a bunch of folks standing, right? The Amex was the curb because people were standing on the curb outside the New York Stock Exchange. The New York Stock Exchange was another club where they're standing, and if you wanted to do an order, you had to put it in there. Well, this putting your servers together in proximity is very analogous to traders standing in a circle in an odd way. So we'll see. There's a lot of headlines on it. But it does do radical things to rental fees in things like Aurora, Illinois, just because that's where the Merck servers are. That's hints at the political question, is there equal access? And I would argue that there's never been equal access, but it still makes a good headline. Circuit breakers and safeties. You guys probably heard about the flash crash. So some of these algorithms, and the thing that when you construct algorithms, you have to be very clear about not having these kind of biases in it. I actually heard the person held responsible for the flash crash talk about what really happened. And basically they were doing an index program, and it was so big, the opportunity was so big, they were very cautious about how they sent out 98% of the capitalization of the trade, and they just sent the last 2% at market. And simultaneously, the people that were viewing the market all pulled their bids. And so we had this sudden crash. So it was a couple of things. One, there was a big opportunity, but people are watching what other people are doing based on the flow, electronic flow. So now they're putting in circuit breakers. There's also something new in the options exchanges are putting in it, that if a trade is just wrong, they're going to bust it. That's really never been the case. Remember, if you're doing algorithmic trading or program trading, certainty of execution is really, really important. So what happens if you do an arbitrage and they bust this trade that they say, well, that's got to be wrong? I've already done the other side. So now you have a new risk when you're modeling, right? You're going to have to put a cap on it to see if it's a big move. You've got to stop your algorithm, because you might get busted on one side and not get the second half of that trade, and that's not a good spot to be in. Other governmental financial risks. There's always been talk about transaction tax. Why in Illinois? I'm from Illinois. I'm embarrassed to be from Illinois. Okay, we have a corrupt government that taxes and taxes and taxes. And their financial transaction tax, they talk about it and they talk about it, and then one day I'm afraid they're going to do it, and the Merck's going to pick up and move somewhere else to Indiana. So I hope they don't do it, but it's a possibility. We also had the Dodd-Frank legislation, which has huge implications on trading. It really concentrates. One of the things it does is it concentrates it takes the trading out of the bank's hands, because they can only do so much proprietary trading. And to me, I look at that as a bit of an opportunity, but it also concentrates a lot of power in those banks. Much talk to level the playing field, slow down access, equal access to information. Again, I never think that's been the case in the past, but there's still talk about it. Anyway, so lots of things that change. So as HFT reached its limits, a company that does a lot of high-frequency trading is GetGo. That's their revenue picture. So it seems like the opportunity is going away as competitors get faster and the speed of light becomes a hard limit. So reviewing of trading strategies. Factor leading to growth in the high-frequency trading world, the use of low-latency computer systems, fragmented markets, attractive pricing with liquidity rebates, high liquidity. Small tick size matters. Every time you cross the bid-ask spread, that's a cost. So if you don't have to cross it, or it's only a penny, that's great. And then there's trade-through protection with Reg NMS, National Market System, which means that if I execute on one of these venues, as I put up there's over 10 venues, I can't cross a bid on another venue. Now with the SEC, it's not an official rule, it's a policy, but I showed you those rebates where some people were charging, some people were giving you money. Did you notice that it's less than a penny? That's been strongly encouraged by the SEC. But in the complex trade world, it's more than a penny. So complex trade is when you give an exchange a multi-legged order. So they've broken the penny in the complex trades because it's not visible on the screen, because no one sees it. But if they allowed rebates and charges to exceed a penny, then everybody would see these prices don't match. I'm telling you they don't match, but you can't see that unless you know the pricing metrics. Pros of high-frequency trading, SIFMA argued improved market quality, liquidity, spreads, lower transaction costs, correct and consistent pricing, overcomes market fragmentation. In other words, the arbitrage nature links these markets together. And there's cognitive limits to the human mind, except for people at Stanford. So the algorithms can do a better job. Boon for retail customers, absolutely. You know, if you put an order in Schwab or Fidelity, you can't even touch your screen and your fill's there. And that's for retail community, that's just love, that people love that surety, that sense of surety. Cons, market complexity, unequal access to trading tools, extraordinary profits, I don't have a problem with that, but possible market manipulation. There's a lot of spoofing. Have you guys heard about that, where people put out dummy orders to try to get the other person to move, and then they hit them the other way? Or there's a lot of games you can play if you just think about it, and they're games as old as time, but it's just an electronic venue. Is you try to learn something about your adversary and then to exploit it. So there's fake orders out there. There was the big guy out of London, right, that got busted at the Merck. The Merck's client was generating a lot of this kind of stuff. So the problems are for the institutional investors, as they usually are. Other possible problems, multiple trading venues have created fragmentation. We've got the NMS system. The problem is the system that links the exchanges is nowhere near as fast as all the proprietary systems. So we did talk about some of the advanced order types, such as peak before routing away. You can peg orders. So exchanges are trying to adapt by giving you more order types to put an order in. So there's two types of general strategies you can create when you're doing an algorithm, or two families of strategies. One is strong force opportunities, and one is weak force. So strong force, generally understood as laws in finance, no arbitrage, law of one price. Weak force are strategies that are relational trading, pairs trading, technical analysis, or sometimes called pattern recognition kind of trades. So, and these types of strategies, both model types have been adapted to high frequency trading. And there's probably more opportunity in the high frequency weak space now than the strong space. Arbitrage is pretty easy to do from a calculation standpoint. Law of one price, that's pretty simple. If the two assets have the same payoff in every state, they must have the same price. No arbitrage condition is another strong force. If two assets have the same payoff, and a riskless profit can be obtained by simultaneously trading both assets, then the market will make sure that they're always in equilibrium. Examples of strong force: index and ETF arbitrage. ETFs are exchange-traded funds. They're equities that look like an index. FX arbitrage, which is really an over-the-counter market more than it is here. You can trade them on the Merck, but the liquidity is over the counter. VIX arbitrage. VIX is a volatility index traded in the SIBO. Put call parity arbitrage and market making. Yes.
What is triangle arbitrage?
Every currency is defined in relation to another currency. So if you have all three, you can define them in terms of each other, and then it's an arbitrage. Triangle only because it's three. You don't actually have to set them up that way. The math is done that way. Strong force strategies: there's low return, low risk, high position turnover, consistent returns. Small data and execution errors can be very costly because you're trading so much. High quantitative and highly computational. They're usually very simple theories because we all know what an arbitrage is. We can write out the equation. Very complex to get, you have to worry about the speed, you have to worry about the rates, the fees, you have to worry about whether you're going to get canceled on one side. Statistical and strategy design, trade execution, and risk management is very difficult. Weak force strategies are based on relationships between assets, and there's a strong theoretical basis typically. There's fundamental relationships such as accounting data, taxes, earnings, market force, supply and demand, and risk transfer. So oil companies will tend to trade together relative to each other. It's not there's no arbitrage there, but if you basket them and trade them, so pair strategies and or industry strategies. So weak force include value and growth, earnings momentum, earnings surprise, dividend growth, tax law effects, microeconomic factors such as interest rate sensitivity, oil prices sensitivity, and inflation. So a lot of times people will use the price of a barrel of oil to trade their equity stocks, or to trade their oil stocks, things like that. Scott, who wrote a lot of these slides, is doing an event strategy where he waits for a number to come out middle of the day, unemployment or oil barrel price of oil inventory, and then he waits for the market reaction, and he has a forecast for the number versus expected, and then he trades the overreaction or underreaction. So a good example of a weak force. Common characteristics are high returns and higher risk, lower turnover and higher capacity, inconsistent returns. We're always arguing for Sharpe ratios, so inconsistent returns are a drag in that regard. Value of forecasts and information determine superior returns, so you really have to care about your forecast. Execution quality is less important. It's a smaller percentage of your edge, but to me it's always important. You don't want to give that up. Highly quantitative and mathematical. And Scott's predicting here that this is the battleground for high frequency trading in the future. So if we're going to build a model, we'll start with a theory. You go strong, no arbitrage condition, or weak. Formulate a theoretical value and adjust your theoretical value to fit the market. Now, there's two kinds of algorithmic development families, and I started this talk about this. But one is that you could create a forecast value, a spot estimate. Based on all my inputs, I'm going to predict the fair value for this asset is a certain number. You could then, the other family is, which I think these two families can talk to each other, but sometimes they're not presented that way. But you could say, well, based on the moving averages and these correlated securities, this looks as if this should trend higher in the future. So not a spot forecast, but kind of a notion of overbought, oversold. I prefer the spot estimate because then you can model the other aspects of execution and define your costs. So if you're dealing with a dollar point estimate, you can say, okay, the current price is X, my forecast is Y, X minus Y, this is a big opportunity, therefore I'll bet big. You can adjust everything you have the scalar mechanism involved. If you're looking at more relational trades that don't come to a point estimate, then you can do things like, okay, well, this is crossed over this moving average by this magnitude, therefore I should change my bet. But you'll see both families when you read algorithmic books, and my bias is the more quantitative one. You have to do a trading simulation. So if you're in a theoretical value standpoint, you're going to have to simulate the trade. You're going to do as much work on how to take your algorithm and interact with the marketplace effectively as you will developing the algorithm in the first place. And so a lot of times people give me a really good idea and I'll say, yeah, it's great, you can't do that trade. Or it's very difficult to do that trade. If I get one more Palladium model given to me, I'll just, Palladium trades very infrequently with a huge bid-ask spread. I'm like, well, it doesn't matter. There's a lot of edge here. You're never going to get it executed. Yes?
The current Chinese market, stock market, which school you think is more appropriate to model it? The spot market or the moving average right now?
The jury is out. You could probably talk about this. The government regulation in that market and the political effects yeah, how do you model that? I mean, that's going to be a dominant factor. So you can do a lot of statistical work, but you've got this giant influence on the market that's very difficult to model. Dr. Velu, do you want to comment on this?
I think, one of the things I've noticed with Chinese market is that most of the rules that apply to US market don't seem to work well for Chinese market. They seem to have a reverse kind of strategies they were talking about. Even someone talked about reverse Bollinger Band, that seems to work for Chinese market, not for the US market.
So as we talked about when we're starting with the theory, we have a bunch of different theories we can pick from. Parsimony is the key, keep it simple. Overfitting is a real problem. And we have one algorithm we're looking at where these guys have done terrific work, and I suggested that they vary their weights on their forecast variables and decay those weights at different decay mechanisms. Well, I've just tripled the number of variables by that request. So you got to watch for overfitting greatly and practice statistical, sound approach by keeping some data clean and on the side. Understanding the idiosyncrasies of the markets, we've talked a lot about that. What is the volatility minimum tick size, liquidity relationship? I'm sorry for selling my guys out, my folks back out in the Midwest out, but someone presented me results last week, and they said, and for some reason silver keeps popping up in every one of these pairs, and I said that's because the price of silver is so low relative to your other assets. You got to normalize the prices, but little things like that where if they were about the same price, it really wouldn't matter, but they're not. If the contract size was the same price. So understanding those idiosyncrasies is key. This is my talk about rules versus theoretical value. People have different preferences. As a TVE model, we'll start with what we call a micro price, add predictor variables. Again, one of the reasons I like this approach, it's theoretical value approach, is a micro price, we'll get into it's about the bid-ask size and what you see on the exchange. But if you have the predictor variables separate, you can go and fix them, right? If it's rules-based, it gets pretty hard to understand how your rules interact with each other. But sometimes rule-based things are easier to write and easier to implement. So some pre-trade analysis, looking for appropriate markets. I told you about a palladium issue. So you've got to find markets that you can trade in. We have in Blackthorn, we have a little group of people that study, and we've pre-approved. You don't have to talk to me if it's in one of these 25 markets and all the listed equities, because they're liquid enough, contract specs are clean, we understand those. But if you're going to get esoteric, you have to come chat with us to make sure we can trade them. You're looking at correlated instruments. High correlation is good for pairs and clusters. Lower correlation is good for single asset strategies. And then understanding what the lead and the lag is critical. And it's not always constant. So if you're using one variable to forecast the other variable, you have to do a lot of work to make sure that the lead variable is forecasting the lag variable, and also have some kind of strength in your modeling that if that relationship switches, you don't bet on it. Let's say an example we used to do is we used to put all the broad-based indices in a screen, and we would typically, and we'd keep track of the tick count and the size, the moves. And typically, we use the S&P 500 as the lead indicator for the other broad-based indices. But every once in a while, that NASDAQ pokes up its little head and starts driving the economy. And so you better be aware of when that shift occurs and change your weights or don't bet. Pre-trade analysis, look for momentum reversions. You can do run tests, measure the excess numbers of positive and negative strings of events. And this is the momentum and reversion strategies. What it really gets to me is what's another critical thing. I talked to you about the lead-lag relationships. Well, securities prices are in general reversion, right? Most prices tend to be dominated by reversion patterns, but that's not always the case. So understanding when an asset or a price you're looking at is in a reversion mode or is it in a momentum mode. I would talk about this as almost changing their state. And models I've developed in the past, we'd have long-term oscillators and short-term oscillators. One would be much more reversion-based, one would be much more momentum-based. And we decay them at different lengths. But securities, sometimes it's a moment of price discovery, sometimes it's a moment of too much liquidity has been taken out of the market and it's coming back. So using volume to help you decide those states is a good thing. Price moves is a good thing. Short-term volatility, things like that. Most statistical tests have been developed naturally. What this really means is most statistical tests you will use when you develop an algorithm, they weren't developed to develop high processing, high frequency trading algorithms, right? So sometimes you need to change your data so they fit in better. So TV or signal generation, we can talk about microstructure analysis, clock versus trade time or volatility time, and then using things like moving averages, trade frequency, trading range. A market microprice. So for our purpose, it's the rules and regulations and order types and a quote and trade entry execution process of a particular market and understanding the nuances of that. So what do I mean by microprice? Well, you could start with the price of the midpoint. You could just use this as a microprice, the bid plus the ask divided by 2. But is that as good as you can do? If you just want to start with what's the price of the security currently? Not what's my forecast, but what's my best estimate of the price of the security? So with that analysis, that assumes that 50% would be on the buy, 50% would be in the sell, and that's not really reasonable. It's somewhat reasonable in a couple of examples, but it's not very reasonable occurrence that's the way if the stock is moving, it's not what's going to happen. So what's the right price to use? It develops on the model. So what I'm suggesting is you start with a microprice model that is your best point estimate in the marketplace. So there's no guarantee you're going to hit that price, but if you have a good starting price for the model, it'll diminish the amount of false positive signals you have. If you always assume you can buy in the bid and always assume you can sell in the offer, you have a great model. It's just not realistic, so you can't do it. So most analysis is measured in clock time, either minutes, bars, or every tick. The suggestion here is that that's going to be limiting. If you think about how does information come into the marketplace, and that's really what we care about, right? How efficient is the marketplace getting information and washing it through? Well, trade time. Every trade might be the better indicator of things, information being incorporated into the market. So don't be just held to using clock time. Trade time adds more relative importance to each data point, ensures the same number of events are used in the analysis, and it just gives you better data. So we do a lot of stuff in trade time. It's not always, sometimes getting that level of detail isn't as easy. Another thing to look at is volatility time. Volatility would suggest, well, that's information coming to the market if things are more volatile, right? I should weight that information more than I should just every minute on the clock. So you can see the volatility of the S&P 500 future. So you can see when information comes into the market. So you want to weight those prices more. Using a moving average is a primary building block for building models. And then how to use the moving average and how do you decay it. But it smooths out the data because there's so much noise in this data, it's very helpful. So there's trade type market indicators. Collecting data by volume bins. This is pretty much what we use in Blackthorn. It just gives you a lot less numbers to crunch so your analysis can go a lot faster. Other trade time market indicators are correlation. And this is don't get caught up in the time nomenclature. Trading is evolving and new methods are developing. So the next thing you want to do is work on your execution logic. As a general rule, the shorter the round trip trade time, the less profitable each trade. The more trade execution performance impacts P&L. So the more you trade, the more you care about this, but I suggest you always care about it. Smart trade execution logic is paramount for successful trading for another reason, because I told you about if you leave your order out there, and someone smacks you, you just lost money. On average, 2.5, 3 cents a share. So getting your order out of the way is critical. So if you start losing your edge or you think something has changed, you got to get your cancel. And this is really, this has just cost people so much money because it's one thing the high frequency folks have done is they've put this discipline on the market. I used to argue that you didn't need a high frequency trading system to do relational trading. And now I'm much more of the camp that, yeah, you do, because you have to get your cancels, have to be so quick. We're not going to make money that way, but we're going to avoid losing it. Most trading strategies you come up with have negatively skewed profit distributions. So you make a little money, lots, and then you lose a chunk. And that could be through a volatile period. It could be the fact that you left your limit orders out there. It could be the fact that long-term capital just put a liquidity premium on every asset class in the country, and you were short that. You know, I didn't realize cruise ships and hotels in New York were highly correlated before 9/11. I mean, but they are. So things like that matter, and so you lose money in chunks and you make money a little bit at a time. Post-trade analysis is key. Simulation backtesting can only answer the model is successful, but you want to use a lot of metrics on what you realize in actual trading is what you forecast, and then break it down. How much was it in your execution logic? How much was it in your theoretical value? How much did you lose because you didn't get your orders out in time? How much did you make by trade venue? Sometimes you can say, how much did you make or lose by counterparty? Because you can see it. And all of a sudden you realize, wow, every time that person trades with me, I should go do what they're doing. So a trading simulation, developing a clean data set. In all my years, there's always been a excess profitability by developing a clean data set, and there still is. You'd think that had to be solved, and it's not. And one of the reasons is that you don't get a clean data set until you run your algorithms, because your algorithms goes and finds the data for you by finding, oh, you can make all this money by trading this, and you look into it, oh, that data's bad. There's so much data, it's so complex, it's very hard to get a clean data set. It's very hard to do your rolls correctly on your futures. It's very hard to get all your options pricing. It's very hard to combine multiple feeds from multiple markets. So you want to estimate your model parameters, you want to optimize your trading parameters, you'll need to do an out-of-sample backtest and quantify your risk, and define your liquidation parameters before you start trading. Don't be in the middle of a war and say, oh, I think we should sell. Know when things are going bad, what you're going to do before you do it. So this is a discussion of the clean data set, and what's the right frequency to use is a big deal. Beware of non-stationarity, what to do about outliers. What do you do about outliers? Flash crash, what do you do? Do you use it? Don't you use it? You know, I mean, those were real trades. So that's a real problem. You got to kind of think about, what am I trying to accomplish? What do I try to do? Now, I would throw them out from a model standpoint, but I would use them in my execution logic. So I would use two different data sets because what I'm trying to accomplish. Making the right assumptions about your ability to trade on a recorded price is a big deal. Develop a clean data set. We already talked about this. Try to avoid closing prices. They're probably the worst price you can use. There's still a lot of marking that goes on because people have to pay margin and put up capital based on the closing price. So try to use something off the close. You know, if possible, collect the data yourself on the same platform you'll be trading on it, because then you'll understand the latency. That'll be the signal you trade off. If you go buy data from someone else, it may not be at the speed or the frequency that you will actually see in your own system. There's no right answer for what is the right time period of a data set. You need enough data to make your statistical significance. Too long a period's tough. Do you use 2008 to model now, or don't you? We have this debate all the time. And my policy these days is, no, don't fit on 2008, but I want to know how the model performed. Right? I don't want it blowing up because 2008 was real, but I don't think it's the best forecast for what the current market conditions are. Generally, recent data is better than old data, but just be aware. Tech stock bubble is another issue. Developing clean data set. Bad data has made a lot of smart people look really dumb. We've had a lot of my folks come and say, oh, they didn't realize that they made their time bars at different lengths where they actually were including prices that already had happened on their analysis for a trade. And so we had to fix that. Trading simulations, think about index arbitrage. When will be the greatest opportunity for profit? What are the latency issues, things like that. Make the right assumptions. And then you estimate your model parameters. So estimating fill rates is another key. Look at the data and develop a reasonable model. A 5% fill rate on 1,000 shares means that your fill prices on average will take 20,000 shares will be traded. Using VWAP to get your proxy on whether you get filled or not is a pretty good way to understand. So just because you put an order out there doesn't mean you're going to get all your fill. So you got to make some kind of modeling. You want to optimize your trading parameters. I told you we use genetic algorithms to do our optimizations. Start simple, simple searches. You want the highest Sharpe ratio. Usually you want to keep your monthly drawdown lower than 20. There's a book called Beat the Dealer. You don't want to go bankrupt. So your bet size has to be limited so you don't go bankrupt, so your drawdowns aren't larger, because if you go bankrupt, you're done, right? You want to do out-of-sample tests. Here's some examples of what you might want to be able to do. And then quantify the risks, your worst period, your total drawdown. And then liquidation parameters. Better to set these scenarios before you start trading. And you should use, all the different strategies, the current model drawdown information, condition, and strategy for phase liquidation. Basically, how are you going to do it? And then execution and trading engine. Speed and accuracy can be as important as the models themselves, and know the relative strengths of your strategies before you fit them. So then start trading. Start out small. We do as small as you can, and then start scrutinizing. So this is a table I put together about the difference between equities and derivatives, difference in strategies. So here are your regulators: equities, SEC, CFTC, options, CFTC. These are options and futures. Options, SEC. So they have rules differences. Historic location: equities are in New York, futures are in Chicago, options Chicago, options on equities in Chicago. So speed and trading type are the implications. Current location: just because they were in Chicago, now they might be electronically linked together, right? And we have options exchanges in Miami now. So for the SEC options, or equities, it's dispersed. Futures are still in Chicago. You have to go to Aurora, put your machine there. Options are in Chicago. Equity options are dispersed against. So it does matter distance from servers. Price discovery and equities. So what's your main driver of your price? Well, if you're just trading the equity, right, stock specific is high. Just because you see what happens in Exxon doesn't mean that's what's happening in the entire oil industry. So medium from an industry standpoint. On the market, it's kind of low by itself. But obviously in the futures, S&P 500 is very high, but stock specific is very low. So where you get your information from is what asset class you're looking at, how much should you weight it. Trading costs in the equity worlds, there's credits and debits. In the futures and the options, there's only debits. In the equity options, there are credits and debits. Clearing is centralized, localized at the Merck, localized, or the NYMEX or the other ones, and centralized for options. So this is a fungibility issue. And then margin and trading. Equities are relatively expensive versus the index, the S&P 500 and the options in the future, and equity options are moderate. It's part of your cost, how much capital you have to put up. And then speed and sensitivity. So those are things you have to take into account. And I'm 30 seconds from my time limit, I think. No, I'm 5 minutes from my time limit. So do you guys have any questions or comments? Yes?
What's actually your view on Michael Lewis' rules? Did you think it was bad publicity for high-frequency trading in general?
Well, I think it is. I mean, it's meant to sell books. So yeah, it was intentionally not written in the most flattering way, but I think it's okay, somewhat accurate. So, I mean, the people did what he's talking about. They didn't lay their own cable from Chicago to. I'm sorry, was this Flash Boys? Yeah, this was. Yeah, the people did it, and then the spoofing goes on. It's known about. So no, there was accuracy to the book, but he did sensationalized stuff. But that's to be expected. Is that your view on the book?
Yeah, pretty much. I think.
Okay. Yes.
When we talk about spoofing, there is also the mathematical theory of stochastic optical control, where how much of the order you actually release and how do you release it, and we can come up with very nice mathematical problems and then solve them. But as a practitioner, what do you think about this entire mathematical theory?
Well, I think that's great, but I've simulated. That's exactly what we would do. We'd have a notion of how much we want to put on, but then we had tick-by-tick data. So we had two data sets. One is one we'd bin to fit the modeling, to fit our forecast. And then we had a tick-by-tick data set, and it was much shorter in duration, but a lot larger in numbers. And then we would take that forecast ability and actually just run it through a simulation. And because we did so much trading, we could tune our fill assumptions over time, right? So if we thought we were going to get, if we send this order, let's say you send a market order, your fill assumption is not 100%, right? Because it might go away by the time you even get there. So you learn your market order fill assumption should be 80% in the security or 85% in the security. So then you can go retune your simulation and run it and run it and run it. But absolutely, having a mathematical model is the key. You got to start with that.
So how do you go about, typically when formulating these problems, there are a lot of assumptions that go into the problem, without which it doesn't lead to mathematical availability. So how do you kind of balance that?
Yeah. Well, again, what I try to do is I break it into two parts. I say, okay, what am I trying to forecast, and what's the best way to forecast that? Not how do I interact with the marketplace, but how I want to predict an asset price. What is the best possible way I have to predict that asset price? Okay, fine. I have my prediction, and then I look at what happens in that forecast and say, okay, it'd be best to bet about this amount of money. Then I come over to my execution logic. Right? And then I say, okay, if I execute in this style, will I get the shares that I want for the bet that I made? And then I guess you just continue to retune them based on your real experience. I don't know if I'm hitting your question or not. But I break it into pieces, right? Break it into solvable questions. People that try to solve the whole thing, forecast value and how to interact with the market, they don't tend to get answers.
There's an iterative procedure where you
over and over and over again. And I said there was a piece in this presentation. Every time you can, you get all your trade results and compare them to your forecasts, and then retune and change your assumptions. We found out. We found out that if two things. If we ever trade on the open, in our high frequency models, we lost money. Unless it was an index expiry, because there's so much information content right on that open that we're not privy to. We're getting our information by looking at how price patterns occur, but there's so much overnight that's built up. We needed to wait for about 5 minutes until we could start seeing the entire market and all the prices moving, and then we could get in. The other thing was we read the news tickers. And if there ever a security we were trading, the news came out, like an equity, we'd immediately stop trading it until we saw that the price was behaving as we forecast. And as soon as our model was confirming what we expected, we went back in. But sometimes, yeah, you just have to get out. You don't know what the other guy knows. It's okay.
Just following that question, you showed a picture of the volatility changing in a day with the spikes.
S&P 500, that's kind of what I was talking about. On the open, there's a big spike.
So some of that is noise and some of that is real information. And is there any way that we can figure out what that is like?
Whether you can do things that verify it.
Yes.
Was there volume with the volatility?
The volatility.
No, I'm saying, was there volume with the volatility? If it was volatility without volume, you probably ignore it. But if there was volume with that volatility, you put a lot of weight on it. Does that make sense?
Yes.
So was there volume or volatility in related assets? Then you put more weight on it. So you do things, you have your one indicator, but you can use things to verify that indicator and even weight it. But they are natural things to piece together.
Any other?
Yes.
So in practice, how often do we use options to mitigate the risk, or we just trading equities with high frequency tradings? Like, do we have a
No, I know. Okay, so if you're only trading equities, you don't have curvature risk, right? So you don't need to go to the options market. But if you're trading as part of your portfolio, you're already trading options, then you have curvature risk. So you have to start trading options to defend that, right? So when we did high frequency trading, we just used the S&P 500 future. That being said, the last thing I was doing at Goldman and what was done by GetGo was moving the high frequency strategies to the options markets. So that was a little bit separate. Now, if you're a portfolio manager or you're just building a more passive strategy, or you want market exposure, you want beta exposure, right? You want exposure to industries, but you can only tolerate so much risk. Well, then I think you define what are your thresholds of pain, and then you can use options very effectively. So, and using options over using futures all the time, the beauty is you don't have to always be in the market, right? If like in 1989, where the hiccup happened overseas and didn't really happen here, by the time you came in the next day, it would be over. But if you had options, you'd be protected from that, if you were long the options, at least. So I think it depends. It was in the slide also. Define what you want your risk profile to look like, and then pick the asset classes to control that within the parameters, whether it be drawdown, volatility, Sharpe ratio, things like that.
So we're going to do in practice, we're going to do high frequency with the equity, whatever. But if we have a certain risk level, we just long the options.
We just trade futures.
The futures.
Yeah. I would trade the S&P or the Nasdaq, depending on. What we did is we put all of our positions and we defined them by Barra factor analysis, Barra short-term model, which was 55. I don't know if it's 55 factors. So we translated all the different assets into these 55 factors, and then we netted them, and then we recombined them, right? Recombined the net to show our net position in the factors, and then we matched that to the best larger securities for the hedge. And so let's say we were really, so if we had a lot of market exposure on, it would our algorithm would say buy or sell at S&P 500. If we had a lot of Nasdaq exposure, buy or sell Nasdaq. If we had a lot of oil exposure, sell an oil future or trade at Exxon, right? So what we did is we made all our risk common, redefine it, and then we just looked for the cheapest hedge out there based on our risk. And we always had very strong risk parameters. We were never, on the high frequency side, we were never long or short more than 10 S&P 500 futures, the big ones. But in a trading firm, that's negligible. That's why we could get 5 billion long, 5 billion short. I mean, we didn't have a lot of risk on because we didn't have 10 billion in capital to put up. So we only needed a fraction of that from a capital standpoint.
I think Peter will be giving a talk tomorrow in my other class too, so you're most welcome to attend that. And Peter will stay for a few more minutes here if you want to talk to him. So let us thank Peter again for coming to the class and giving this talk.
Welcome. I've put some business cards out there too. If anybody wants a business card, you're more than welcome.